Hi everyone. As you know, we are not really big fans of Cnbc, the contrarian news business channel. We don't watch it day in and day out. But I did happen to see this segment with Rick Santelli, who we do like, and he absolutely nails it. And he makes a comment that we found rather interesting. He said that he was not surprised, nor were we, with the market sell-off this past week. Listen to what he has to say. And if you want to get some insight as to who we are and what we are about, stay tuned for a minute or two afterwards, and I want to show you some of the proprietary tools that we show our monthly members virtually every night, and the tools that reside on the desktops of our annual members. Let me play you Rick Santelli.
I would say that I would have expected some worrisome signs considering everything we've been through, how long they kept rates low, how they have used their models and trusted all the data given that seasonalities may be a bit different than they were pre-pandemic. I'm not surprised. As a matter of fact, if you look at the one-week charts, the week to date, I mean, we closed at 438 in the 2-year. You can't make that. It's a huge move. He's right. I just don't think it's surprising. And if you look at 419 closing 10s. Now, here's what's really interesting. I continue to say that these guys, one of the big trades everybody's talked about that is working quite well is that steepener, 2s, 10s. It's hovering under -10 right now. It's at a 2-year, the least inverted. And look at the VIX. Right now, it's flying at the highest level since March of last year. And that is a good segue for this guy. Hi, Chem.
Hey, how are you, Rick?
If I do recall, we kind of warned viewers last time we chatted last week that volatility could get really juiced, especially some of the sector rotation. Why don't you pick it up right where we left off?
Yeah, buy them when you can, not when you have to, right? The reality is there's a rotation that's been going on. Risk is in the market. Ultimately, there's a buyer and a seller. It's a zero-sum game, right? But when risk gets concentrated into a part of the market and leverage, it becomes a problem. So a very violent rotation like we've been seeing can catch certain people off guard and really drive volatility at the center of the market. And that's what we're seeing, along with poor vol supply in the back end of the curve. Now vol is starting to expand, and that becomes a self-fulfilling prophecy.
Yeah, we've talked about this reflexive kind of strain that's always present in the market. We were talking about it with regard to mortgages. So mortgage rates are moving lower now. Maybe they'll get to 6.5. Maybe they'll actually get lower than that. But what can that do? What do we think of?
Well, it's asymmetric, right? There's enough pent-up demand. We're running a demand-style economy now that when those rates come down, much like they did in December when they started pricing in the cuts, you can see a pretty quick reaction to GDP and to growth. The problem is it's a slowing economy. It's dramatically slowing. And there's a wealth effect, which is ultimately with the market coming down, reflexively slowing the market at the same time. So we'll likely get demand, which will drive inflation.
And pricing pressures, and the Fed's going to have to deal with its own medicine. But yet, we all know that housing is huge if you want to try to spark some life back in the economy. Any final thoughts?
Well, I would watch, Powell and what he has to say coming up. I think they were very vague for a reason in the last commentary. I think they really have an adjustment to make. This is a reflexive machine, and he's watching these markets closely. They say they don't manage markets, but markets are money supply, and the more the market goes down, the more problem we have with liquidity.
Absolutely, and anyone who doesn't think they have both eyes on equities today is probably wrong. Tyler, Kelly, back to you, and try to have a good weekend. Don't look at your 401K.
Now, our members know what this screen is showing, our monthly and our annual members. Our monthly members get to see a video view of this algo plus other algos every night, Sunday through Thursday. Our annual members also do, but they also have this tool on their desktop. What is this tool? This is called the SMC Swing Machine Plus, and it's tracking the trend. And the trend is so important in all assets. It's operating on the TradeStation platform, in particular their proprietary tool called Radar Screen. We have plugged in the yield curve, 90-day Treasury, 5-year Treasuries, 10-year Treasuries, 30-year Treasuries. The yield on the 90-day paper is 5%, not 50. You just move the decimal. Now, I'm not dyslexic. It's just the way it gets reported. But this is the actual yield, 5%. And so if you say, well, Mr. Banker, I want to give the government my money for 5 years. Well, he'll say, in that case, we'll give you a 3.6%, 3.7 for 10, 4.1 for 30. And you might be saying, well, that's crazy. Why would they pay me less if I give it to them for a bigger time commitment? It doesn't make sense. No, it doesn't. That is the inverted yield curve. And you see, this was not printed by me, but printed by our algo. The dynamic yield curve went negative on November 9th of 2022. Now, there's a lot of misinformation about this negative yield curve, that the very day that it goes negative, the economy goes into recession. That's not true. It takes about 1.5 to 2 years for the economy to react to this negative yield curve. Now, we don't have enough time here to fully explain why, but we are now 1.5 years into this negative yield curve, and we got markers just a few short weeks ago that the recession is in full bloom. Despite what you're hearing from the politicos, especially the politicos that are in power, the economy is in recession. And we can see that negative yield curve widening out. Now, why do the treasuries, and the treasuries, by the way, when yields go down, they go up. Why are they going down? Because the Federal Reserve doesn't control the interest rates here. Why are they going down? The people who have billions and billions of dollars, Warren Buffett, Mark Cuban, they know about this negative yield curve. They have pros working their money. And when the economy goes into recession, they don't want to leave their money exposed into growth stocks. They're no longer interested in getting a return on their money as much as they are to get a return of their money. Because during a recession, the revenues will go down, the earnings will go down, and the stocks and the stock market will also stall. So what they'll do is they'll plow billions and billions of dollars into longer-term treasuries, not seeking the 3.7 or the 3.6 yields, but just seeking safety so that they can get the return of their money when the recession is over. And of course, like always, they'll buy assets when they're on sale. Now, the Federal Reserve is most likely going to come in probably next week and cut the interest rate here. They have to, and they're probably going to cut it by 50 basis points or more. And the market is going to yell, yay! And the market's going to rally, and the really, really dumb money is going to come in and buy stock. You shouldn't do that, or at least we're not going to do that. Because you see, the reason why they're going to have to cut rates is that banks borrow money on the short term. And if the longer term rates are falling, not for good reasons, but for bad reasons, if they don't cut, the banks will collapse and they'll have a banking crisis. It may be unavoidable, but that's what's going to happen. And our members are going to have a front row seat, and they understand this and they're prepared for this. They're protecting their portfolios. Aggressive traders are making money as the markets go down. Let me show you something else. Not that, I want to go to the VIX. This is the 9-day VIX, the fair gauge, 30-day, 90-day, 6-month. 12 days ago, 13 days ago, our members got the signal, risk off. That meant to stop buying calls. That meant to get insurance on their portfolios. And aggressive traders, that meant to get puts, where they have doubled and tripled their money in just a couple of weeks. The VIX futures on a daily basis went risk off 7 days ago. The weekly is telling you risk on pause. It could be here for a while. So I know you're probably on your phone with your broker, right? Joking. If they didn't call you, or you're subscribing to a service that didn't warn or alert you to this, and worse than that, not educating you, then maybe you want to visit our site. We don't make specific recommendations to buy or sell. We don't manage anyone's money. We don't make any claims. We are a mentoring site for those few people that want to take control over this part of their life and would rather not be subjected to the CNBCs of the world when they tell you, just don't look. Look the other way, not us. Have fun.